Commodities aren't just making noise in 2026, they are rewriting the rules for ETF investors. From supply shocks to massive structural shifts, hard assets are moving fast. And if your portfolio isn't positioned for it, you are stuck in neutral while the market accelerates. Joining us now to break it all down, sharing the biggest commodity trends and the ETFs to capture them, is John Love, CEO of USCF Investments. Hi, John. Welcome to the show. It's great to see you again.
Hello. Thanks for having me again.
So much to talk about. Let's dive right in. You know, on the supply side, we are seeing both deficits and outright shortages amplified by the Iran conflict. Asia was the first epicenter of physical oil shortages. Could we see a scenario with even bigger oil shortages elsewhere, possibly even here at home in the U.S.?
Definitely elsewhere. Probably not in the U.S. to a large extent, except maybe on the West Coast. In some markets like jet fuel. California is a virtual island when it comes to energy. So there's no oil, there's no product coming over the mountains or from the oil-rich regions in the central U.S. And so we're in California reliant and most of the West Coast on seaborne crude and jet fuel, and that jet fuel is. A lot of that comes from Asia, where they have a shortage. And so everyone's competing for supply. So, I think it can definitely get worse as the longer this goes on. We've had a couple of things that have mitigated the worst of it so far. One thing is, supply chains, we've been able to reroute barrels, although that's putting them at sea for longer periods of time. So even when somebody can find a cargo, it's taking longer to get it. We've obviously had these releases from the strategic petroleum reserves in developed countries, which has helped. But that is, largely been used. Another release could happen, but we're getting pretty low in terms of historic strategic reserves. And then there's been demand destruction, flights canceled, all these other things. So I think the next place we'll see it, it'll get worse in Asia. We'll have some problems in Europe. The UK probably will have some issues. I think jet fuel, some issues. But in the U.S., we, because we are producing so much of our own crude, that's number one. And two, because where we're getting our exports from the most part, could be Canada, something like that. We're still able to do it. Where it's going to hit is the price. Price of gasoline will stay elevated, jet fuel, diesel, all of that. And it could go considerably higher as everyone's competing for the same molecules of crude.
Yeah, it makes total sense. And of course, California is already feeling that pain at the pump. Then you add on the peak summer demand colliding with the geopolitical supply shock, gasoline, of course, surging, unleaded, roaring. Break it down for us. You kind of touched on it, but what is happening in the gas market right now?
Yeah, same thing. I mean, the major input to gasoline is indeed crude oil. So, different refiners process different crude oil. So, supply chains being messed up, it has driven up the price of gasoline, as everyone knows, in tandem with that. Gasoline prices, and at your local station aren't necessarily precisely correlated to, say, the futures market or crude oil futures or any particular crude. There's other things that go into gas prices, but that is the primary driver. The interesting thing is if you do look at the gasoline futures, that's kind of they track the wholesale price of gasoline. They've gone up even more, and that's what we hold in UGA. The United States Gasoline Fund is gasoline futures. They've gone up more than the retail price of gasoline is tracked by AAA, somewhere closer to 60%, whereas probably in the mid to high 40s% for retail gasoline. So it's high. And could get higher, but that's one particular way that things have differed a little bit is that a product using gasoline futures potentially offers a little bit of a hedge against that, and maybe even a little extra in terms of tracking that price.
The USCF Oil plus Bitcoin Strategy Fund, your ticker there, WTIB, it combines exposure to crude oil and Bitcoin. Can you explain the mechanics of this fund and then how it fits within an investor's portfolio?
I would categorize this as something that you'd look at when you're looking for uncorrelated strategies. So, typically some of the first things people look at after stocks and bonds would be maybe real estate, which is largely reflected in stocks, but also commodities, which are, not correlated with stocks and bonds. And also, obviously, there's this excitement for crypto, for Bitcoin, that kind of thing. So the mechanics of WTIB are pretty simple. For every dollar that's invested in the fund, we buy $1 of exposure to crude oil futures and $1 of exposure to Bitcoin futures, or some Bitcoin exposure could be the underlying ETFs as well. But what we're basically doing, it's a leveraged fund, but it's not 2x oil, it's not 2x Bitcoin, it's 1x oil plus 1x Bitcoin, and putting that together. And the reason that might make sense for some people is, one, oil and Bitcoin are not correlated. The coefficient's about zero. So not only do you have an uncorrelated strategy with stocks and bonds, but you have two things in this portfolio that I think is using leverage in a smart way. It can be volatile for sure, because those are two volatile instruments. But when you're looking at an uncorrelated strategy, volatility is your friend, because you don't want it just sitting there when stocks and bonds are tanking. You want to see something, hopefully that's offsetting those things. So we kind of put that in a portfolio of uncorrelated strategies where you might have broad commodities, you might have other alternatives, and you might have crypto. This is a way to get both in one basket for kind of two for the price of one in a way.
John, one more thing before you take off. Despite the recent correction in gold, its structural tailwinds remain massive, driven, of course, by exploding U.S. national debt and incredibly volatile geopolitical landscape. So how does USCF approach gold exposure differently, especially with strategies that can generate income?
Sure. Well, very simply, we have a ETF. The ticker is USG. That's our gold strategy fund. And what we do is we invest in gold futures. Some gold warrants the portfolio can hold at times, and then we sell covered calls on the futures positions, and that generates that's to generate the income. So the idea with gold is, there's a lot of gold fans, but there's other people too that are like, I'd like some gold, but I don't like that I don't get a dividend off of it, or I don't get any income. This is a way to produce some income while you maintain your gold exposure. So it's really quite simple in that regard. It's just, have a exposure to gold, but have an income stream that's coming from that. And that can vary based on option prices and, how the market behaves. But we think that's something that kind of takes away some of that resistance to holding gold at particular times.
As always, you guys have something for everyone. John, thank you so much for joining us. It is always a pleasure to speak with you, and we will see you soon.
Thank you very much, Stephanie. Great to be here. Thanks.
You're very welcome. Don't just watch the commodity markets, ride them. Join USCF on Substack for real-time commodity insights. Hit the link in the description section below. And that's going to do it for today's episode of Spotlight. If you enjoyed the show, please tell us in the comment section below and by hitting the like button. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.